Global Business Insight, where we go into more details behind the leading business headlines. They say no news is good news, and indeed it is, with no news of escalation of Middle East tensions, gold dips, and market sentiment is provided with some relief. Iran was quoted as also saying it will not take further actions that could escalate the tensions. For now, markets are expecting the Federal Reserve to begin to ease rates more like September. However, later this week, we could get the United States Core Personal Consumption Expenditure Price Index data for March. This is the Fed's preferred gauge, and the gauge could shift expectations of when interest rates will begin to be brought down. Investors are also looking at first quarter GDP growth print for the US coming out on Thursday. The forecast is to see 2.5% growth, much stronger than that implies robust consumer spending, which could put pressure on prices, also allowing the Fed to hold on to higher rates for a bit longer. Eurozone consumer confidence released by the European Commission is a leading index that measures the level of consumer optimism to spend. The euro area print remained broadly stable at minus 14.7 in April, below expectations of minus 14, but still the highest level of sentiment seen since February 2022, suggesting a positive outlook fueled by hopes of the ECB, upcoming interest rate reductions from the ECB, and it also reinforces previous data showing the euro area slowly climbing out of an economic slump. We will replay the story we took earlier on implications of the US House passing 4 bills now heading to the Senate to provide $95 billion of aid to Ukraine, Israel, and Taiwan, along with a measure to force TikTok parent company ByteDance to sell the app. No surprises, global military spending was said to have hit a record high of $2.4 trillion in 2023, up by 6.8% from the previous year and set to go even higher. The Stockholm International Peace Research Institute said the Ukraine-Russia war, tensions in the Middle East, and other trends account for the rise. The raging tensions all over the world is forcing countries to think differently about their security outlook and fortify their arsenals. Also, we discuss, as the World Bank IMF meetings wrapped up, the announcement that Nigeria qualified for processing a loan described as virtually a grant of $2.25 billion from the World Bank at 1% interest rate. We also look at capital importation in Nigeria. First, what is looking like a solid rebound, hopefully, was evident in Wall Street after steep losses last week, and as the risk-off mood eased a bit with calm restored in the geopolitics. Investors focus on major technology firms' earnings this week and the key inflation personal consumption expenditure print out later in the week. Tech stocks may have been oversold after disappointing results from Netflix. That was last week, as we see a comeback of favorite technology stocks today. Nvidia advanced by close to 3% in early hours of trade, back from a 10% drop in the last session. Meta, Amazon, and Apple also positive as well. And in the UK, the FTSE 100 closed at an all-time high, as rising expectations for UK interest rate cuts weakened sterling and boosted corporate valuations in London. The index rose 1.6% to close at 8,023, overtaking the previous record of 8,014 hit in February last year. The majority of the index's constituent companies earn revenues in dollars and benefit from a weaker pound. Tesla shares fell 4% earlier in the day as its latest global price cuts fanned more concerns. Earlier in the day, we did consider some of the woes of vehicle makers in the run-up to Tesla's results, which will also be out later this week. Chinese smartphone maker Xiaomi also announced that they had launched an SU7 electric car earlier this month, priced $4,000 less than Tesla's Model 3, claiming it also had a longer driving range. Late Saturday, Tesla slashed the price of the driver assistance software that it calls FSD, or full self driving, by a third to $8,000 in the US. It had been $12,000 before. Tesla has been cutting prices of all it can, everywhere it can. The EV slashed prices of its cars globally after its first quarter deliveries fell for the first time in nearly 4 years amid a glut of inventory. In China, Tesla's market share shrank to around 6.7% in the fourth quarter of 2023 from 10.5% in the first 3 months of the year. Tesla cars may be technologically loaded, and features like autonomous driverless capabilities are good to have, but regulators do not like them, and people may just not want them badly enough to pay what Tesla is asking when wallets are squeezed and costs of borrowing are high. Also, the environment of geopolitics and trade protectionism is complicating the global business model, and that is also impacting brands like Tesla. Other traditional car makers are also facing their own challenges. Volkswagen workers in Tennessee just voted to join the United Automobile Workers as unions continue to gain a foothold in the US automobile factory space, seeking better wages and benefits. As traditional vehicle makers step up their own EV investments amid all the headwinds, including higher costs, they argue that a unionized EV industry will put them at a disadvantage. Also, technological and mechanical progress is making cars last much longer. Models are shifting away from traditional multiple vehicle ownership in the new, more efficient mobility models. Again, more pressures likely to erode margins further for cars. After months of bitter wrangling, the House of Representatives passed a bill in the US to appropriate $61 billion to help Ukraine defend itself against Russia. It also passed three other bills, one to help Israel, one to deter China from attacking Taiwan, and a mix of measures including forcing the sale of TikTok to a non-Chinese owner. All four bills, a combined foreign assistance package totaling $95 billion, are expected to pass the Senate within a few days. Tying the TikTok bill to a crucial aid package for Ukraine and Israel is perhaps an obvious way to ensure it goes quickly to Biden's table. Certainly, it will go to the courts. China will stand in the way of the sale of the TikTok algorithm, and the valuation will be steep. Last week, Biden called for a 25% tariff on certain Chinese steel and aluminum products. This comes in addition to tariffs put in place by Trump on some products. Mr. Biden says he is investigating Chinese shipbuilding subsidies and is working with Mexico to block Chinese tariff evasion. And to encourage more in-country productions of chips, Biden unveils almost $20 billion for Intel to boost US chip production. Still on protectionism, this time in Europe, there is an increasing sensitivity to awarding defense contracts to companies that are not headquartered in the EU. This was as the EU states debate proposals from Brussels for a defense industrial strategy, which encourages prioritizing EU-based defense companies over non-EU suppliers. And as costs of doing business escalates with all the protectionism, the developed weapon producers are likely to get richer with the huge defense outlay, and the cost of war is passed increasingly to aggressors, of course, as defined by those writing the checks. Indeed, we could see more wealth and growth moving to developed economies, similar to the emergence of the US as an economic power after World War II. The Global South have little choice in the new defense and trade protectionism, which WTO cannot question, but to revert to defend themselves with their own brand of protectionism. The result is, of course, more fragmentation, trade corridors, and higher costs, which feed into the stickiness of supply-driven inflation. With more inshoring, nearshoring, and friendshoring, foreign direct investments are not just chasing yield, but aligning to geopolitical corridors. The environment of higher costs and interest rates means returns are lower, and the business case is tighter. Incentives are needed to be much more attractive than it used to be, say, a decade ago. Investors are also having a lot to deal with and will be less tolerant of toxic macroeconomic instability or an unfriendly climate to do business. Nervousness has not abated as the present dynamic of hostility stokes up the likelihood that open warfare between Israel and Iran will continue. Such a war could invariably draw in the United States, Iran's regional proxies, and perhaps even neighboring states. The global contest between democracy and autocracy, between a US-led international order that values human rights and freedoms and a world safe for dictatorship and predation, is moving to a higher gear. Some analysts argue that US policy regarding the wars in the Gaza Strip and Ukraine suggests that the US is selective in how it applies its rules, and with its own divisive domestic debates on things like reproductive rights playing now in an election year, it's unclear whether Biden will risk votes by backing Israel in an all-out war, and that could embolden Iran. The mood on geopolitical risk remains a dire red, and risk premium on oil prices can only inch up in the near term, even though so far prices have been quite stable, suggesting a significant premium is already priced in, and concerns over supply are balanced as US promises to put more oil in the market in the busy summer driving season. Meanwhile, petrol prices in the United States have started inching up again. Nigeria was often at the center stage at concluded World Bank IMF spring meetings ended as the strong duo of Nigeria's central bank governor and minister of finance made it clear that Nigeria was open for business, reforms are serious, and the handshake between the fiscal and monetary side is aligned to usher in a different era of progress. The contingent did not come back empty-handed. The federal government qualified for processing a loan, virtually a grant of $2.25 billion from the World Bank at just 1% interest rate. According to the finance minister, Wale Edun, the package approved by the board of directors of the World Bank offers a 40-year term with a 10-year moratorium and a nominal 1% rate. Q4 2023 total capital importation into Nigeria stood at $1.09 billion, slightly higher than $1.06 billion recorded in Q4 2022, indicating an increase of 2.62%. But compared to the preceding quarter, capital importation rose by 66% from $655 million in Q3 2023. FDI imported in Q4 was just $184 million from $60 million in Q3 2024, more than tripled, but far less from where it needs to be. Just to make my point on the performance gap, South Africa recorded FDI inflows of $1.35 billion in Q3 2023, over 10 times what came into Nigeria in the same period. It was a relief to see markets almost all back in the green in Europe and also in the US, a combination of abating of the risk-off mood and expectation of a stronger week on technology earnings, and in Europe the sense that rate cuts may not be far off. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and following.